Here's another question that I get asked quite frequently, and someone is selling a house and they ask, can I move my mortgage? So I've sold my house, but my mortgage is either the rate's great or my penalty is so large that I don't want to pay the penalty. And yes, the answer is yes, you can do that, but there's a few key things you need to be aware of. So I'm going to go through a couple scenarios. And this is actually called porting your mortgage. Most mortgages are portable. Typically, line of credits are not portable, but most mortgages are portable, but they all have their details can vary greatly. So I'll go through some of that with you. So imagine someone has a $200,000 house, and they owe a $150,000 mortgage. And their rate on their mortgage is, let's imagine their rate's at 4%, because it's a nice even number. There's a few different scenarios, and I'll show you how each of them and where they can differ. So first thing is these guys are buying a house, and they've just been transferred. They're moving to a new town, and they're buying a house for the exact same amount of money. So in their case, minus the real estate fees, they could move their mortgage. They could have a $150,000 mortgage and move it, no problem. The big thing is how much the timeline. Every lender has a how long you can port a mortgage, and it's usually in your mortgage documents, but if you're not sure, just call your lender, and it varies from 1 day. So there's some lenders that literally you can only do it if it's the same day you can buy a house and sell a house. There's others that you can do up to 120 days. But the key thing is you can't do it indefinitely. So you can't just put this mortgage on hold and say, well, I'll pick it up again in 6 months. As time goes by, you're going to be limited in what you can do. So look into it early and double check your options before you actually are in the process of, before you've sold and are you're buying. So in this case, there's no new money, but the timeline would be important. Very straightforward. I'm going to show you a second example. So this is imagine this scenario. There's someone who has a house, and they're moving up. So these same thing. They have a $200,000 house, and they've sold it, and they have a $150,000 mortgage, and their rate's at 4%. And let's imagine the current market rates are now at 5%. So this is a perfect example of when you would want to do this. So they're paying only 4%. If they were to get a new mortgage, they'd pay 5%, and they are going to buy a house because they're having kids or whatever the case may be for $300,000. So we know they have. So let's look at how this would break down. They have a $300,000 purchase. They have a $50,000 down payment. Now I'm assuming no real estate fees, just to make the math simple, but there would obviously be some real estate fees on the sale. So they're going to need a mortgage of $250,000. So how this works is they're going to put a new mortgage on this property for $250,000. And that mortgage, so we'll look down here at this mortgage. This mortgage is going to be made up of two parts. There's going to be $150,000 at 4%, because that's the old rate. And then there's going to be $100,000 at 5%. So what they do is they don't give you two more. Most lenders won't actually give you two mortgages. They're going to blend these together. So they're going to give you one mortgage for $250,000, and let's assume the blended rate comes to 4.35%. I'm not going to actually do the math on it because it can vary, and it doesn't matter for our illustration. I'm just showing you what can happen. So you would get your mortgage rate is obviously better than the current market rate, but it's not as good as your old rate because you have new money. So it certainly can be done. You can move your mortgage. Again, timeline is important. You need to know how much time you have to buy that new place once you've sold your place. So that's simple enough. It can be done. And in this case, if the new rates are higher, it would make a lot of sense. I'm going to show you another example where someone can do this. So let's imagine people are in the opposite stage of life. So these people are actually downsizing. They have the $300,000 house. The kids have all moved out. They don't need all that extra space. They have a $100,000 mortgage, and they are going to buy a condo for, let's say they're going to buy a place for $200,000. 200K. Now, in this example, you'd think, well, if they sell a place, let's just look at the math, 300 minus 100, which is their debt, leaves them with $200,000. You may say, Scott, they could just buy the place cash, and maybe they will, and sometimes they do, sometimes they don't. But for this example, let's assume that they want the extra 100 grand because they want to start a business or whatever. They don't want to actually pay off their mortgage right now. So if they wanted to move their mortgage, and they wanted to have a $50,000 mortgage in the end. They knew that, okay, out of the 200 grand, we'll put down 150. So they're going to put down 150 as a deposit. So we'll go 150. That'll be their down payment. And they want to move that $50,000 mortgage, because let's say that mortgage is at an excellent rate. So let's say it's at 3.25%. And they want to move that, at least some of that money over here. So this means that the new property in this example would require a $50,000 mortgage. So this can also be done. You can actually move your mortgage and decrease it. So let me explain a few things about how that works. Again, key thing here is timeline. Make sure that the dates line up so that you can actually do it. Second thing is that you are going to trigger some penalty on fixed rate mortgage in Canada. Typically, they do have penalties. So I'm going to use an estimate here just for this, but a $100,000 mortgage at 3.25% with 3 months interest would probably be about, just let me do some quick math. So it'll be maybe less than $1,000. Let's say they'd be paying $1,000 in penalty. But the other thing is that, let's say current rates, in this example again, current rates have gone up and they're at 5%. So they don't really want to get a $50,000 mortgage at 5%. They would rather keep it at 3.25%. So what happens is you would pay a penalty, but only on a portion of that $50,000 that you paid down. So if this is your current mortgage, and this is probably the most confusing example, and if you have questions on this specific thing, you can always email me. But so their current mortgage, this is the new mortgage, so there's obviously a $50,000 pay down, and most mortgages would have a limit on how much you can pay them down per year. And let's assume this mortgage has a 20% pay down. So that means that $20,000 can be paid down without penalty, but there's still, because they've paid down 50, there's still another 30 that they would pay a penalty on. So they would actually incur a small penalty in this case. But incurring the small penalty is probably cheaper than taking on a new mortgage at a higher rate. So as you can see, moving a mortgage is actually, it can be done in various situations, whether you move up, you move across, or you move down. You need to be aware of the timeline, and you also need to actually do an analysis on whether or not it even makes sense to get a new mortgage or not. So hopefully that clears that up. If you have questions on porting a mortgage, you can send me an email to scott@scottpeckford.ca.